Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video we are looking at one of the best dividend kings out there in my opinion. This is J&J or Johnson & Johnson. This is one of those sleep well at night companies that you don't have to worry about. It has a AAA credit ratings from S&P, which means it has a better ratings than the United States of America, the whole country. So what I would like to do is to kind of give you an overview. Again, if you're interested in basically this company, do your own research and find out a bit more information. But before we do that, I just want to stop here and ask you if you could press that like button, subscribe to the channel, and let me know if you have any questions, inshallah. And don't forget to join us on the Patreon account, where you can get access to the private Discord, where we also have a Sharia compliant investing ebook and other dividend trackers that you can make use of. And this is one of the ways to support the channel, so it would be really amazing if you can do that for us. Now, the company a year to date is actually down about 13%, and this is what attracted me back to the company. So I want to tell you exactly what I'm doing with it at the end of the video, so stay tuned for that. So right now it's about basically since the beginning of the year, it's actually down almost to 13%. So it has not done anything this year. The S&P 500 is up, but this company is actually down for the year to date, which is not great if you think about it. However, this is the type of companies that I like to buy more of, and that means it could, this could present a great opportunity for long-term investors. Now, in the 6 months is about down about just 2%, and when about 1 month is about 2.5% up. Now, like companies like Microsoft, the Nvidias and so on, they up almost to 200 or 40%, 50% this year. But this giant company, which is right now basically almost a 377 billion market cap, is actually down about 13%. So I want to give you an overview, see basically where the company is heading in terms of where they are now. Now, this company has recently splitted from Kenvue, which is now the consumer products. So all the consumer products now is part of the Kenvue, and this company is now mainly pharmaceutical side of things. So they have basically different sectors, as you can see, or segments within their revenue. So neurosciences, for example, infection diseases, immunologies, and oncology, and so on. So this is basically the latest quarter. This is basically the third quarter that they've actually reported in October, I think it was. Okay, and as you can see, it's a nice breakdown. So the revenue is not just coming from one area, it's coming from different areas. And within immunology, they have quite a few drugs in there that is quite well known around the world. I'm sure some of you work in this industry, you probably know a lot more than I do in terms of the products this company has. And if you work in that sector, of course you definitely have that advantage. But as you can see here, I definitely like the breakdown of their product and so on. And there's a lot more information you can actually find out within each sector. So the medtech, for example, has the surgical and the vision and side of things, and then you've got a few more sectors or segments, if you like, the interventional solutions and so on. So within the medtech basically highlights, you can see it's also within that is diversified. The reason I like the companies to have a diversified kind of portfolio of products that they sell is because if one goes down, so if the company is not doing well in oncology, for example, or neuroscience or whatever, then at least the rest of that segment will pick up, and then it kind of balances out. So the company is not going to report earnings that are basically declined a lot. And one of the things that I always worry about is when investors start selling a stock because it actually one segment went down and so on, and especially within a quarter. Okay, so the third quarter they might report a bad one, and then it starts selling them. Now, when you look at the long-term trajectory of the businesses, there's nothing wrong with it. Everything seems absolutely fine, and they're still on track to actually basically make they increase their cash flow, if you like, increase their net income, which is what we're after, and the revenue goes up every single year. So by having a company that's basically has a decline of one quarter and the next one actually picks up, shouldn't basically stop us from basically investing in these companies. So you really have to be careful, because the most important thing for us is 2022 is basically this company was making this much. right now in 2023 is making this much. So that's improvement from where it was before, but the one segment within that might have not done as well as it should have. And in this case, both segments is actually done well, but of course that can easily happen. So that's the kind of thing you really need to watch out when you're starting investing, because you hear a lot of noise. So you just ignore that noise and just focus on the long term. Right, let's have a look at the company. Like I said in the beginning, it's the healthcare company, currently trading $155 per share. The EPS is $13.51, a market cap of 387,377. We saw that and here. Okay, so of course, because the market is open, it kind of fluctuates. It has a wide economic moat. Beta is very, very low, and this is what I like to call, the reason I call this company sleep well at night, because you don't have to worry about whether the markets are going so much or whatever. You don't have to worry about this company. It's not going to go down, 20-30% or 20-40% every next month. Okay, current PE is about 11. Okay, let's call it 11 and a half. Forward PE about 15.8, and the 5-year average is about 17. So based on this, it seems very cheap right now, and price to free cash flow is about 25. Now the sector for the healthcare, which is quite weird because as that sector has been down quite a bit, it's about 13 right now, and the S&P 500 is about 25. So I've got this information from Finviz, so I'm not sure if that's actually true, because the healthcare is down quite a bit. Anyway, the annual dividend is right now almost to 3%. The payout ratio is 44%, which is actually decent. So that gives them room to improve that dividend if they need to. The latest increase was 5.3%, which is absolutely fantastic. And the 5-year growth rate of 6%. The dividend growth streak is 60 years in a row. Companies that pay their dividend 25 years are called dividend aristocrats. So 25 or more. 50 or more are called dividend kings. So this company has been a dividend king for 10 years now. The annual payout that you will receive every single year is $4.76 for every share of this company that you own. The dividend safety is 99%. So that's the highest rating any company will ever get. The free cash flow right now is $17.7 billion for free cash flow right now. They can do anything they want with that money. Okay, and the free cash flow yield right now is 4.2%, which is quite high in comparison to what we're normally looking for, and free cash flow margin of 16% in comparison to the 5% that we're normally looking for. So the company is doing really well. The dividends are great. It's covered the dividends. They have enough cash in the bank to actually pay us, inshallah, and of course buy back their own shares and all of that stuff. Free cash flow is one of the most important things that I look for in a company, because that gives us the opportunity to invest in a company that's going to buy back their own shares, pay off any debt, invest in the business, pay us the dividends, okay, and all of these amazing things the companies can do. Profit margin right now is about 14%, operation margin of 26%, return on invested capital, return on equity, of about 17, let's call it about 18%, and total return in the last 10 years, including dividends as well as price appreciation, about 7.7% on average every single year. So that's what you will be getting every single year. To basically return on invested capital, we're looking at about 14%, and revenue growth in the compound annual growth rate of basically let's call it about 5%, and current ratio is up way above 1, which means they have enough liquid cash if they need to, that they can liquid assets they can liquidate if they need to in the next 12 months. Now the earnings, the Yahoo Finance analysts, they're looking at basically right now about 7.3. They're expecting the earnings to grow about 7%, just above 7%, and then after that just above 5% every single year. This is what I expect from this company. Okay, 5 to 7%, 5 to 10%. That's the companies, because it is a huge company. They already they can't grow any faster than that. It's quite hard for these companies to grow. So what they do is organic growth can sometimes kind of slows down. So what they do is they acquire other smaller businesses to incorporate into their business. So that's why they need that free cash flow. So at fair value right now, according to Morningstar, is basically $164. It's about 3% discounted from where it is now. Fair value according to Simply Wall Street is right now $238 per share, which means it's 33% above 33% undervalued at the moment. Tip rank is saying about $178. That's about 13% upside from where it is. It's a moderate buy from them. 175 from Seeking Alpha, 11% upside from where we are right now, and it's a buy according to Seeking Alpha. So based on this seems basically it's discounted right now. And in terms of Sharia compliance side of things, okay, we'll be looking about 10, almost basically 100% in terms of business activity side of things. Interest bearing debt is very low, which is absolutely beautiful, and interest bearing securities is also very, very low. And as you can see here, they have been buying back their own shares. So some years they don't actually buy back more, but some years they have been buying more of their shares, which is absolutely wonderful to see. In the last 10 years, this is what the company has been doing, which is really good. Now, for me, it's definitely a buy, and I'm going to tell you now what I would be doing with my shares, and I'll show you how many shares of this company that I have in my portfolio. So as you can see right now, I have 35 shares of this company. I'm up at just about 2%. That's, you know, it gave me the opportunity to actually buy more of this more shares of this company recently. So I bought 2 more shares. I used to have 33 shares, so I bought 2 shares. I think it was the end of last week that I bought. So I've received the dividend from them actually recently, and as you can see here, I bought about 2 shares of this company. So that's all I wanted to share with you guys today. I hope you enjoyed the content. If you like the content, subscribe to the channel. Let me know if you have any questions, as well as that, of course, join us on the Patreon account, and you can get access to the Discord, where you will have, inshallah, brothers and sisters who are actually genuinely helping each other to be better investors. And that's all we're trying to do. No one in here is saying basically we are, you know, experts in this thing, but all we're saying is basically we are out here, we're trying to help each other as much as we can, and we're sharing. I'm sharing this portfolio every single time I actually record a video. I share it with you guys, whether it's up or down, just to hopefully to inspire someone out there to start investing and so on. And we can talk about the, you know, the importance of investing and all of that stuff another time. But have a wonderful day. I'm going to stop the video here. Take care. Assalamu Alaikum.